Okay. Here we go. All right. So thank you all for coming tonight. We're going to discuss some interesting topics. We're going to do our schedule for tonight is going to be very simple. We're going to do some moving average stuff. We're going to start with big picture, just where are we? What are we doing? What's happening? We're going to be looking at it through the lens of not a micro trader, but through the lens of an institution. So we're going to be looking more objectively as opposed to emotionally. This is not a business for emotions. You can be emotional as a human being, but you have to make sound business decisions. So we're going to discuss sound business decisions. When I do these things, I like to always make it that it's practical, meaning I want you guys to be able to actually walk out with something and be able to take something and move it forward. Because if not, what's the point? You can listen to me ramble and listen to my nonsense, but if you can't do anything with it, you might as well watch a pot of boiling water. You'll probably get more out of it. I like to try and make them value adds. Okay. Everybody hearing me clear? Okay. Don't be shy. So I'm going to tell you, don't be shy. Okay. Okay. So let me ask you a question. We're going to start off with an analogy. Okay. Market's going down. We're going to stick with equities and indices. We're going to stick there. Okay. Market is going down. Okay. This is an analogy that I heard from Peter Lynch. Everyone here know who Peter Lynch is or have heard of Peter Lynch? Okay. I take pauses and I'm reading the chat. So that's why I'm just taking pauses. Okay. So Peter Lynch pretty much is a legend, right? Agree or disagree? He's pretty much a legend in the equity space, right? So Peter Lynch basically said a couple of things. He said like this: when a person goes to buy a car, a house, a TV, stereo system, well, I'm sorry, a home theater, he said stereo, it was a while ago when I heard this, a home theater system, even if they buy some stupid, dumb piece of crap on Amazon, they do hours and hours of research. And they watch YouTube videos on reviews. They read every review under the sun, and it's the dumbest thing. And they spend hours on this. How many of you have done this? Where you're going to go buy something, and you just sit there before you pull the trigger. You just sit there and you read all these reviews, and you try and figure out whether you should buy this thing or not. How many of you have done this? Yeah. Okay. Peter Lynch says very simple. Before a person buys something, they do all of these research. However, when it comes to the stock market, they have no problem dropping 10 grand on some stock that somebody talked about in a Starbucks, at a water cooler, in a store they overheard. They have no problem doing it. They just right away, they heard about the stock bulb. Okay, they just go and they'll drop 10 grand, 20 grand, whatever it is. They don't think twice about it. They do no research on the thing. How many of you heard people who've done this? Or have you done it yourself? You heard about some stock, you don't know what the hell it is, and you just buy it. Okay. So that is not the way to conduct either a business as a trader or as an investor. Okay. As an investor, you're buying a company. So you're taking ownership of something. They're not, as Peter Lynch likes to say, stocks are not lotto tickets. That's not what they are. They're companies. Okay. They're going back and forth, up and down all day long not because of the trading aspect, but investors are trying to figure out what the actual company is worth on a market value. That's what they're trying to figure out. Okay. Now, we're going to get to the market in a second, but I'm going to give you a little bit of a background. Okay. So when you hear these big numbers that NVIDIA lost $20 billion in market cap today, right? You think to yourself, my God, the company must be falling apart. Market cap and market value is not the same thing as the value of a company. It's not the same. Okay. Does anyone know how to get market value? How that calculation is done? Exactly. It's the current share price versus the shares outstanding times the amount of shares outstanding. That's how they figure out what the company's actually worth. Very simple. Okay. You don't have to know because it's really irrelevant to you. Where does this become relevant? How many of you have been involved in the markets for a while, and you'll see when a company gets bought out, a lot of times there's some kind of premium to the current share price, whether it's 20%, 30%, 40%, 50%. and the shares explode higher, and then they just basically die because they basically go to the offer price. But the offer price is a certain percentage above it. Let's assume it's 50%. So it's called a 50% premium over current market price. Has anyone heard that before? Where they've seen these takeouts, or they've seen these buyouts? Okay, so you know what happens? You know what that is? That's the real value of the business. Because what they do is that the investment bankers will then take the company's financials, pull it apart, and try and figure out what the company's actually worth. Realistically, not its share price. What is the actual company worth? And then they can determine from there what is an appropriate share price, or what is an appropriate multiple for the acquirer to spend. Okay. That's how this whole thing works. Okay. So when you're seeing shares and prices moving all day long, let's say, for example, today, we're going to get this little introduction is because to give us an approach for what took place today, and then how we can move forward. Okay. Now, it's not just company earnings that affect the share price, right? There's economic data, there's macro data, there's recession. There's many things that affect a business. Okay. Because again, these are not lotto tickets. They might feel like they're lotto tickets, but they're not. These are companies. Apple is a company. It is not a stock ticker. Okay. If Apple went private tomorrow, Apple's business continues to run. It's a business. Okay. It's very easy to get caught up in the Vegas lights of up, down, red, green, markets going up, Apple's going down, Apple's going up, and you get caught up in this. But the reality is that they're businesses, and their share price is a reflection of what the market thinks their business is worth. Now, what's interesting about the stock market, as opposed to any other market, okay, as a spot market, and when I say a spot market, that means a cash-based market. So, for example, how many of you trade oil or natural gas or gold, or look at them? Okay, you've looked at them, right? It's a future, right? That's what it's called, a future. Okay. The ES is a future, right? For those of you that trade ES, it's a future. That's right. That's what it's called, a future. You're trading futures. By definition, it's telling you it's future price. It's not current price. It's future price, because that's why it's called a future, right? Makes sense. They sound like stupid questions, but they're not. There's a point to it. Okay, perfect. Okay. The cash market, meaning the SPX or the NDX or the SOX, are cash markets. That is technically the spot market for equities or the US stock market. Okay. Futures are always trading higher than the current spot market. Why? Because it's future price. People are trying to figure out what is going to be the price in the future. Okay. The stock market in general, as a cash market, is forward looking. So when they're pricing stocks, they're not looking today, doesn't matter anymore. They're looking future. Where is this thing? What is the market going to look like? What is this company going to look like in 6 to 9 months from now? Not today. I don't care about today. Today who cares? It's a foregone conclusion. Now it's, what are we going to look like in the future? Okay. So inherently, stocks are technically both spot and future at the same time. Spot because it's the current price, because you're getting that, but future because the market's constantly trying to figure out where market participants are trying to figure out where are these companies going to be in 6 to 9 months. Okay. That's step one. Step two, the market in general. Okay, and keep this in mind for those of you that trade stocks. I'm going to call them equities. Just okay. Keep in mind, 84 to 87% of all stocks follow the direction of the broad market on a daily basis. Let me repeat that. 84 to 87% of all stocks follow the direction of the broad market on a daily basis. Okay. So if the market is going up, then 84 to 87% of stocks are going up. That doesn't mean that they're rip roaring, but they're going up. And vice versa on the downside. Okay. Now, this brings us to today. What's going on today? Before we get to screen sharing, what is going on today? What do we have that's freaking people out? So whether or not you appreciate the current administration or not, there is a seismic shift from Trump 2.0 from Trump 1.0. And this is important. Trump 1.0 was very stock market. Every day was stock market, every single day. He was tweeting about the stock market. He was thinking about the stock market. He was talking about the stock market. He was quoting Wells Fargo analysts about the stock market. It was a constant thing in your face over and over again. And when the market would have a down day and the market would start bouncing, he would tweet. Yesterday was a tough day, but today looks like a good one. And he was doing this over and over again. It was stock market all day long. And for those of you that don't remember, when the market would get hit, like on a day like today, you know how he would stop the bleeding? You may want to take a guess how he would stop the bleeding, how he would stop this from happening, how he would stop the market dead in its tracks and get people to come in. Anyone want to take a guess? You may not know. That's okay. No, it's not a tweet. It's a good guess though. The tweets all happen at 7:30 in the morning. Midday, what would he do? I'll give you all a second for a guess. You're not going to be able to Google it. It's either you know it or you don't. What he used to do was he used to drag out Larry Kudlow every time. Larry Kudlow would come out on financial TV, whether it be CNBC, Bloomberg, Fox, whatever it was, and he would talk the market up. And that's how he would stop it. It was consistent every single time. Okay. He was so stock focused. He was like almost like a day trader. It was like crazy. That was Trump 1.0. Trump 2.0. I hate to break the news to all of you, because it's going to really be a bubble popping right now. And now I speak real, so I apologize. It gets a little rough, the language. I'm going to try to keep it clean. Does not care about the stock market at all. He's in office now, about roughly 2.5 months, something like that? 2 months, 2.5 months, something like that. He has not mentioned the market once. He does not care about the stock market this time. Like, at all. As a matter of fact, the reason why does anyone know why we went down today? Does anyone know what took place this morning? Anyone want to take a guess? And it wasn't data. The money, honey? No, it wasn't her. I hope that, I give the two a second to write. Yeah. Christian just got it. He's talking recession.
Yeah, right.
He's talking recession. That is not, Trump is talking recession. Okay. Tariffs, all of these things are recessionary. If the market believes, and it's all perception, if the market believes that the economy is going to go into recession, what do you think is going to happen to certain companies? And don't say the words they're going to go down. I don't care about stock price. From a business perspective, if the country is going into recession and people are going to have less money, no, they're not going to close. What's going to happen to their sales? Their sales are going to drop. Exactly. Their sales are going to drop. But here's the other thing. Was anyone paying attention to what Powell said on Friday? Because this is crucial. Because this was what really, it was these two things that really set us off. Yeah, there you go. You guys said it. You guys caught it. Yeah. Powell said that the Fed is in no rush to cut rates. That's very important. Because if you're not cutting rates and you have a recession, and you have the president of the United States telling us that there's going to be a potential recession, that is a 1-2 punch that the market needs to figure out. Where the hell are these things going to be? Where the hell should these companies be priced? Where should things be? Now, because it's an index, so SPX, ES, NDX, NQ, because they're indices and they're indexes, by definition, an index means a basket of something. It's a basket of underlying something. It's not just in its own little vacuum. The S&P does not move in itself. The S&P is not a ticker. It's a nothing. It's a group of 500 names. It's 500 stocks. That's how this thing moves. The NQ is the NDX. It's the NASDAQ 100. It's 100 stocks. We can talk about the weighting in a second, but it needs something underneath it for it to move. If the SPX didn't have 500 stocks, then the SPX is nothing. It's a nothingness. Like the VIX. The VIX is not tradable. Does everyone know that? The VIX that everybody looks at, do you know that is not a tradable thing? I'm not talking about the derivatives. I'm talking about the VIX itself is not tradable. It is a mathematical equation. That's what it is. It's a nothing. Okay. You have derivatives. You have VIX futures. You have UVXY, VXX, you have things. But the VIX by itself is just a nothing. It's a mathematical equation. The SPX, leaving the derivative part out of it, meaning the ETFs, the SPY, the ES, the SPX futures, so the SPX options, the SPX by itself is an equation. It's an equation of 500 stocks that are weighted a certain way, and that's how this equation comes out. The Dow is the easiest. Why? Because the Dow is 30 names. You end up all 30, divide them you end up all 30 names, divide them by 30, there's your price. The S&P and the NDX work differently. Okay? So far, we're good? We're clear so far? Why is this important? The reason why it's important is because it puts context in what is happening on a daily basis. So for example, on a day like today, I mentioned this, I said I was going to regurgitate it, so I'm going to have to, and I'm going to. You can't look at the S&P was down 155 handles. A handle equals, it means a point. You cannot say the S&P was down 155 handles, the cash. You can't say the NDX was down 770 handles. You know why? Because inherently, an instrument that's $20,000 is going to have big moves. It's inherent in the way, just the nature of a $20,000 instrument. A $5,000 instrument or a $5,700 instrument is going to have big moves. So you have to look at it from a percentage point, meaning a 2% move is a 2% move. It doesn't matter if it's 2% in a $20 instrument or if it's 2% in a $10,000 instrument. 2% is 2%. It doesn't matter. So you have to take a step back on the emotional side when you see these big numbers. Oh, the NDX was down 770 handles today, or they'll say the news 770 points. What is that? But what contextually, what does that mean? Yeah, being down almost 4% is a ginormous move. Don't kid yourself. That is a big move. Okay. But it's still 4%. It's not 770 points. It's 4%. Because imagine that this was the price of the Dow. Okay. So let's just do a quick math. Let's assume that the Dow, what is the Dow now? Let's assume, what's the Dow? 42,000? I have no idea. What's the Dow? I don't look at it. So let's take a quick look what the Dow is. The Dow right now, let's forget it. Let's assume that the Dow is 45,000. Okay. Fair enough. Is that cool? We'll just keep, for the sake of this argument, let's assume it's 45,000. Okay. 45,000 times 4% is equal to 1,800. It's still 4%. On a $45,000 instrument, it's 1,800. On a $20,000 instrument, it's 770. The same 4%. You understand how the math is working here? You get it? You understand? Am I losing anyone, or are you so far? You're all cool. Okay. So it's always important to think in terms of percent. Why is this important? It's very simple. Okay. The computer, okay, the algo, I like to call it the computer, okay, is looking for certain percent moves off of highs. You may not believe it. That's what it does. There are certain algos that are designed and programmed to do certain things at certain times. When the algo or the computer is programmed that we're 10% off highs to buy, you get a move like we got today. We were close enough. If you look at the way we bounced, okay, you look and go a little bit granular. We were close enough to 10% that a huge buy program came in. The buy program did not come in because shorts were covering. The buy program came in because we were X amount percent off of highs. We were close enough to 10% that this buy program kicked in. Why? Because the computer is designed to buy at 10% down, 10%, 15%, 20%. At certain percentages, it's going to kick in, and you're going to get these massive buy programs that come in. It's not short covering. It's a program that's designed to do this. Okay. The bounces are going to be very violent and very vicious. Again, it's not short covering. It's a computer that's going. Now, the best way to explain how does an algo work in terms of orders, does anyone have an idea of how many orders an algo can shoot out in a minute? Serious question. Anyone want to take a guess? The algo can shoot out over 10,000 orders in a minute. 10,000, not 1,000, 10,000. So the algo has a lot of money behind it because, again, these are institutions. Okay. So they could just shoot these orders out. Now, you say to yourself, okay, what are they buying? Remember, it's an index. So you know what? They're buying the underlying stocks. The ETFs are programmed the same way. The ETFs start buying, like the SPY or the SPXL, which is a double leverage thing. So you have all these underlying forces that are blowing things into the market quickly. Okay. And that's why you get a move like this. Are we out of the woods? No. Is this going to force the Fed's hand? Probably not. Probably not. Okay. But that's why we're reacting the way that we're reacting. So it behooves you to write down, and this is something you could do practicality. Okay. Go to the S&P cash, the SPX, mark off the high and start making a spreadsheet or make a cheat sheet. You can do it at 2.5% and 5%, whatever it is, and mark it off until you get to 15.5, until you get to 20%. And you'll know exactly where these things are. This is where the market potentially could be going. Okay. We got down to about 10% and we bounced. Okay. Does that mean it's a sustainable bounce? I don't know. My crystal ball is not working today. But what I do know, more importantly, is that there are certain reference points that now will start to tell me when that bounce is going to change. Okay. Now we're going to get into before I get into the screen share, are we cool? I was one of the Globex and talk to you. So the algo in the cash market only works in the cash market, 9:30 to 4 o'clock. There are algos that work in Globex, but the algo that we're referring to right now is only in the cash market because that's the only time it's open. And the question is why? You just asked a very interesting question. Because you do have electronic trading from 4 o'clock to 8 o'clock and from 4:30 in the morning till 9:30. You know what the difference is, Brian? Order wise? Want to take a guess? Nope. Order wise, not volume, order wise. There you go. No market orders. It's limit only. So with that being said, because of that reason, the algo that can get stuck because when the books technically close, because the market's closed, the books get incredibly thin. So let's just say, for argument's sake, that Apple has on both sides of the spread. Let's just say, I don't know, let's make up a number, 100 shares on each side. When the books close at 4 o'clock, it could drop down to 3. If you've got an order for 50, you're shit out of luck. Because if there's someone ahead of you that gobbles up those 3, you're not getting any of them. So that's why the algos get turned off in the cash markets. Okay. Globex is different because Globex is, number one, there is market orders that's continued because it's a 23-hour market, so it does continue. However, because the cash markets are not open, it is my opinion that trading Globex is not appropriate. If you're going to trade U.S. equities or you want to trade the stock market, I am of the opinion you should only be trading it from 9:30 to 4 o'clock because that's when the stocks are open. Underlyings are open. If the underlyings are not open, what exactly are you trading? A hope, wish, and a prayer? What are you trading? Because I can tell you right now, and you've seen it many times, as soon as 9:30 opens, the 9:30 bell goes off, futures go a completely different way than they were doing all night long. Why? Because now the stocks are open and the index is actually being calculated according to the stocks, not according to speculators in Globex, who to be Globex traders they're basically guessers. Once the market opens and the stocks are actually opening and the indexes are calculating, then it becomes a whole different ballgame. That's why you'll see, for those of you that trade Globex and then look at 9:30, you say the market was going up all night long, and then all of a sudden we had it all last week. The market was going up all night long. 9:30 happens, and the market just takes a dump all day long. Who saw that happen all week? It happened every day last week, for the most part, if I'm not mistaken, that we were moving up all night long in Globex. 9:30 happened, and it was boom. We went straight down. Who saw it? Who recognized it? Who was sitting there scratching their head trying to understand what happened? The difference is the futures markets can get ahead of the cash market overnight. But once that cash market opens, there's a saying, futures lead, cash follows. Who's heard that saying? That saying, futures lead, cash follows. Who's heard it? No one's heard this saying before? Now you heard it now. Okay, good. Thank you. When the market opens at 9:30, the cash market takes over because now the stocks are open and the stocks are going to tell you what's going to happen. That's why you could get moves where all of a sudden futures can turn on a dime because the stocks are going up, or futures are going up and then the stocks turn and then all of a sudden the market takes a dump. At 9:30, the equity market takes over, specifically in indices, not anything else. I'm just talking specific to indices. Okay. Remember, it's a basket. There's an underlying. Okay. The underlying is very simple. It's Apple, Microsoft, Amazon, Google, stuff you're touching and using every single day. NVIDIA, Netflix. These are things you're dealing with all day long. You may not forget about from the stock perspective, but these are things products you're dealing with all day long. Okay. Okay. Let's get to the screen share. Enough of my nonsense. Are we cool so far? Are we all right? We all good? Am I not boring you? Am I putting you to sleep? I'm putting you to sleep? Oh, that's great. Just kidding. How will this change with NASDAQ? How will this change with NASDAQ being open 24th? The NASDAQ open 24 hours? What do you mean? With the overnight, with the US, with stocks trading overnight? Oh, yeah, it's not happening for a while, to be honest with you. Remember, let me just make bigger a second. Remember one thing, okay? First of all, everybody see the screen? Yeah, don't worry, I didn't forget about it. I didn't forget. I wrote it down. Okay, so this is my personal opinion. I'm going to say it right now. It's my personal opinion. It could be very controversial, but I'm of the opinion that 23-hour trading or 24-hour trading, but 23 hours, I think is meaningless. I think it's pointless. I really believe that. I believe that things need to calm down. Okay. I use the analogy of a high school kid. Okay. When I was in high school, there was no cell phones didn't exist. Okay. I'm not going to tell you how old I am because whatever. But when I was in high school, they didn't exist. I'm saying it's the truth. Cell phones did not exist. People had beepers. Okay. If you wanted to make a phone call, you had to use a payphone. Okay. Then again, cell phones did exist, but it was like $50 a minute. It was like insane. So to a large extent, they didn't exist. Let's say it like it is. Okay. So the reality is, if you were a high school kid, and I'm just using this as an analogy, and you had a bad day, you were able to go home and recuperate from that bad day. You didn't have social media. There was no Facebook, no Twitter, no Snapchat, none of this stuff existed. So if you had a bad day, you could go home and recuperate from your bad day. You could come in the next day and be refreshed. Nowadays, okay, because it's 24 with social media, if you have a bad day as a high school, I'm just using high school. If you have a bad day in high school and you come home, that bad day comes home with you. It never ends. It's 24/7 in your face. So you never have a chance to take a step back and recuperate from your bad day. I look at the 24-hour markets in the same vein. Now it's not going to be, they'll be closed on the weekend, but the 23-hour markets, a lot of times, and that's just a bad day, but if the market has a bad day, whatever it is, you need cooler heads to prevail. You need people to just take their foot off the gas and figure out what are they going to do? What's happening? If it's constantly on and it's in your face over and over again, you never have that chance to rest and put yourself together. Okay. So let's use how do really shorts get blown out of the market? Honestly, how do they really get blown out? How do you get these capitulation days and these blow off tops? How does that happen? What happens is that because the equity markets close at 4:00, like the high school kid, 4:15, you can start to get your mind together and figure out what's going on. And you have a chance to see. And then you just eventually reviewing overnight, you're saying, oh my God, if this thing keeps going, I got to get the hell out of this thing. Okay. You're not in the heat of battle. You have a minute to gather your thoughts and figure out what you're going to do next. If you have 24-hour markets, you never get that opportunity. Ever. Okay. With equities, that's why you get these gaps. Okay. Because people are trying to figure out like what's going to be. So for example, I'll give you let's give you a perfect example right now. Okay. Here, let's look here. Let's look over here. Everybody see this when I'm pointing? Everybody see this? Okay. I got 2 yeses. I'm good. 3 yeses. Okay. I'm good. Okay. Imagine what happened over here. Okay. Let's just use that same, no, forget the doji for a minute. Forget about the candle. Let's assume, because it's a gap. I want you just to focus on the gap. Okay. You have a gap here and a gap down. You have 2 gap downs. You see that? 2 holes. You see it? See the holes? One here, one here. You see them? Okay. Imagine you're having a bad day. Okay. You're trying to figure out what to do. You're long. Okay. You say to yourself, if this thing is going to open up down over here somewhere, let's just say, I'm throwing in the towel. There's your gap. We gap down, we gap below it. The hell with it. I'm out of here. I can't deal with it. I can't take it anymore. It's the emotion coming in. That's what causes these holes. Okay. You get orders blast through when we're closed and the market just opens up either higher or lower than where it was. Now, for me, a gap is not defined by close. It's defined by where we are in relation to the higher low of the previous day. That is a gap. Okay. Everybody cool with that so far? Beautiful. All right. Let's just take a look at the S&P. Okay. We're going to talk about S&P and then we're going to get to the moving averages. And then I'm going to get to GLM. I'm going to call you GL. GL's question, because it's a great question he asked. Okay. So just to give you an idea of moving averages. Okay. When you're trading, and it doesn't matter if you're trading, make sure I'm crystal clear here. It doesn't matter if you're trading futures or you're trading equities. Okay. I view futures and indices through the lens of an equity trader. Okay. The reason for that is because the equity traders are really the ones in control. They control the market from 9:30 to 4:00. Okay. Again, indice, basket of stocks, underlying. The equity traders are trading the underlying stocks. Just so you should know, in times of heightened volatility like now, equity traders are not in individual names. Now you'll get a few that will be. I'm not saying they're not, but from the professional standpoint, they're trading the SPY, the Qs, the IWMs. That's what they're in, because that they control. You can't really control individual names. So it's just much easier just to trade the market, because the market has the volatility, because the names could get stuck. Okay. So just to give you an example, if you were trading the S&P today on the short side, you were making money. If you were trading Apple where people were hiding, you made some money, but it's not as advantageous as, let's say, the S&P, which is falling out of bed. See the difference? I know there's big bars. I get it. But if money's going to hide in Apple, then even if the market's getting crushed, you're not really going to get the same type of juice. I'm using Apple as an example. Okay. You with me so far? So far, so good?
Emma's bottle's ready.
So far, so good, guys? Okay, good. I'm sure you all use moving averages. I'm sure you have all different types that you're using. I'm going to tell you what I use for equities. I use this for equities and I use this for indices. I'm not a moving average trader. That's not what I do. However, at the same time, I am aware of them because I need to know what the equity guys are doing. Okay. When I'm trading the future side, I'm looking at certain things. I want to know what the equity guys are doing because I know what they're looking at. Okay. For the most part, okay, they are pretty much all looking at EMAs. The reason being is because an EMA puts more weight into current price than it does an SMA, which basically just smooths everything equally. So the best way to think of it is Dow versus S&P. The Dow is an equal weight, 30 names divided by 30 names, add them up, divide by 30. That's how you get your thing. S&P price weighted. Okay. That's the way you could look at it to dumb it down. Not that any of you are dummies, but just to dumb it down a little. Okay. So equity traders are looking at EMAs. That's what they focus on. They do not focus on SMAs. I'm not talking about YouTube guys and Twitter guys. I'm talking about professional traders are trading EMAs. Yes, on all time frames. Now, We're going to get to timeframes in a second. That's what they're looking at. For the most part, they pretty much all look at the same ones. Okay. They all have a 200. They all have a 50 on the EMA side. That's a guarantee. Okay. Where it changes a little bit is on the faster moving averages. Some will use an 8 and a 21. Some will use 9s and 20s. 8 and 21, 9 and 20, potato. Okay. I use 8, 21, 50, 200. That's what I've been using since the day I got involved with equities. And that's what I'm comfortable with. I understand them and I just go with it. Okay. But again, 8 and 20 versus 9, I'm sorry, 9 and 20 versus 8 and 21, tomato, potato. You got my point on that? It's not so much the moving average. Okay. What becomes important is something called slope. SLOPE. Who remembers that from when they were in high school? Gonna get flashbacks of math class in high school. Slope, okay, is just that. What direction are they going? Are they pointing up? Are they pointing down? Are they flat? What are they doing? Okay. If you see moving averages like this, where you have your 8, so the white, so just so you know for yourselves, the white is an 8, the blue is 21, the green is 50, the red is 200. Okay, you guys remember that? Okay. When you see that, and you see the slope like this, everybody see how it's all sloping down? And you have them stacked 8, 21, 50. See that? Forget about the 200 for a minute. You see the way they're sloping? If you're looking to be a buyer, okay, you're taking trades only. That's all you're doing. You are not holding for multi-day, what would be considered portfolio approach. Portfolio approach means you could put on, so let's just go up here for 1 second. You see over here where the moving averages are all stacking up? You see this? Down over here, you all see this? If you're 8, you're 21, you're 50, everybody see this? In the corner over here where I am? Okay. This is portfolio approach. You can sit in a bunch of names and you can just sit in it. And this is a daily, by the way. You can just sit in it, and we respect the 8-day. We pull in, we hold the 21, we keep going, and you can just sit all day long. And we break and we'll, et cetera, whatever, then we reclaim and go back into it. You see that, how it's going, trade tracking like this? Your 8-day is your fastest moving average, okay? It's going to react the quickest to price, the fastest, because it's 8, right? Your 21 is going to be your medium term moving average, okay? Because it's going to react, again, it's 21, it's going to react to 21 bars of price, okay? In fast markets, fat bars, you see how these are big fat bars? See this? All the way over here, big fat bars. See them all? Your faster moving average is the one that's going to be in control. So your 8-day is the one that's in control. And you'll see like a warm blanket. Okay, we slam into it, get rejected, keep going. You see how we're holding it? We're just riding it the whole time. We're just respecting it the entire time. Everybody see that? That's what you get in big fat bars. High velocity like we have now. Okay. In markets where the volatility is not as strong and the market is just grinding its way, the 21 becomes in control. So even though we were riding the 8-day, you see how the 21 basically held, bounced off of it, kept going over here, riding, cracked a little bit, holding. You see how it's just basically, you see how it's reacting to these moving averages. Now, the idea is, okay, not so much the moving average in terms of let me buy the moving average or let me sell the moving average. It's more, what is the pace of the market in terms of how it moves, and then which moving average is now in control, which allows you to figure out how you should be approaching things. Meanings. I know what I just said was a mouthful and it probably made no sense. So let me start again. Meaning. If you want to be in quote unquote portfolio approach, you want to see, this is what you want to see stack. This is what you want to see. You can hold on to stuff. Okay. Portfolio approach does not mean hold on to things for 6 months. Okay. The normal way to view it is 3 days. You buy day 1, You add to your positions day 2, you trim and trail on day 3. Now, if you were doing that and you bought day 1 over here, you're adding over here, you're pretty much all good. You were good for quite some time. That's portfolio approach. Okay. Portfolio approach works in long. It's a long strategy. It's not short strategy because you're not short a portfolio. You're long a portfolio. That makes sense to you so far? I think some of you fell asleep. On a day like today, where you see the market is like this, okay, once you see the moving averages like this, get the hell out of the way. I'm going to say plain and simple. Okay. You do not, as a trader, I'm just going to tell it to you like it is. I want to keep it real. You do not score points for getting your butt kicked. There's no badge of honor for sitting with your buddies and say, oh, I got cleaned by the market today. Why would you want that? Why would you want to be in a situation where you're getting your head handed to you? What's fun? That's why you come to work, so you can get clean. It doesn't make any sense. So when you see this twist where all of a sudden everything starts going down and you see the moving averages are all crossing like this, that's your sign. Get out of the way. You can test levels and you can test. And by the way, a level does not mean a definite, because I'm going to tell you something very simple. And I want to make sure that I'm very crystal clear on this. Okay. And I want you to really pay attention to this. Okay. If you draw a line on a chart, if you draw a Fibonacci or whatever you put on your charts, a moving average, whatever it is, if you think for 1 second that if an institution or somebody with money behind them needs to move something, if you think your line, your moving average, your Fibonacci, whatever you put up there is going to stop it, I've got news for you right now. It is not. Now, you see a lot of times, it's just unfortunate in this business, you see a lot of this, what I like to call the Monday morning quarterback syndrome. Miraculously, everybody always has a way of finding some moving average, some time frame, some Fibonacci that they drew, some Gann fan, some nonsense that they figured out that they can slap on a chart and say, look, it stopped at my level to a T. Let me tell you something. There's nothing in trading, nothing that is to a T. There's areas. If you're doing limit orders, okay, then that's to a T. But you're looking at areas. Specifically, when it comes to stocks, it's areas. Okay. Right now, the market is stopping, or the market found a bottom, sort of. I don't want to say a bottom. We stopped over here today. Okay. We stopped over here in an area. It's an area. Look, if you go look to the left, it's an area. Okay. That's what this is. This is an area. So for those of you that are going to ask me, how would I know that the market is turning? Okay. I start to try and figure out a way to do it. Okay. So now, how would I have done this today? Very simple. It wouldn't have worked. It wouldn't have worked today, but I'm going to use Friday, if that's okay. Is that okay? We use Friday for a minute, just for the sake of this example. Is that all right? This is where I would be using what's referred to as the 80-20 trade. Okay. The 80-20 trade is just that. It works 80% and it doesn't work 20%. That's why it's called 80-20. Okay. It's also called a red dog reversal. It's a very famous trade. Okay. A guy by the name of Scott Redler invented this trade. It's his bread and butter trade. It's one of his biggest bread and butter trades. It's either RDR, red dog reversal, 80-20, however you want to refer to it. Okay. This is his claim to fame type of trade. Okay. What's the trade? When you have a market like this that's coming down, okay, you're looking to find a way to catch or to anticipate when the market may find a bottom. Okay. So in this particular case, the market comes down like it did. Okay. Takes out the prior day's low, slams down, makes a tail, comes back up, reclaims the prior day's low. Okay. You would then be getting long. Where would your stop go? Underneath the current day's low. Okay. And you're looking for either hammers or inverted hammers as a signal that something may have changed. Okay. Would this trade have been a good trade? Yes. Would it have worked today? Absolutely not. Does that mean it's not a good trade because it didn't work? No, no. Outcome is something you don't control. You only control process. That's it. Everything else, you don't control it. So I'm going to ask you a question before we move forward. How many of you do this? Okay. For those of you that hold for a little bit longer than 2 seconds, you put on a trade and you sit there and you stare at it and you root it off. Go. How many of you do that? How many of you have done this? Come on. It's okay. Don't be embarrassed. And you sit and you tick watch. The thing goes up 3 ticks or 3 cents. And what's it called? And you're like, yay. And it goes down against you two ticks. You go, oh, how many of you have done this? Oh, you've all done playbook, no playbook. Come on. You've all done this. Everybody's done this at some point. Can I ask you a question? A serious question. When you get into something, do you think that thing cares about you go? Do you think it really cares about that? Forget about the fact that it doesn't care. They don't even know you're in it. The market participants have no clue that you're in it. If you scream loud enough, it'll hear you. The market has no clue that you're in it. So sitting there and doing that is a big, giant waste of time. And by the way, what kind of way is that to live your life? Seriously. It doesn't make any sense. On top of that, when you sit and tick watch, you already put yourself at a disadvantage because then the psychology takes over and you'll never get to where you want to be. I'm telling you, you will never get to where you want to be. Never, ever. I can tell you right now, when I get into positions, I never look at them, ever. All I do is I put my stops in. I set my timers because I work with price and time as a breakout trader. I'm very dependent on price and time. And that's it. Everything else, it's up to the market gods. It's not up to me. Okay. So the reality is, okay, this trade would have been a fine trade. Unfortunately, it didn't work today. There's nothing you could do. There's nothing, you can't control what took place today. Okay. Had you taken this home on Friday, where do you think you would have gotten out if you were wrong? Where were you wrong? Where would your stop have been for today? If you had bought this on Friday, where would your stop have been this morning? Take a guess. Let's see if any of you were paying attention. Oh, there's pop quizzes. Yeah, we make webinars with pop quizzes. There you go. Exactly. The previous day low. And guess what? If you're wrong, okay. Now I know you're saying, okay, it's when there's money on the line and it's very easy to say that. I get it. If you're confident in what you're doing and you know what you're doing works, then it becomes no big deal. The size is irrelevant. It becomes no big deal. There are very few things in the world that I think I'm like that. When it comes to trading, I know I'm just right. And I'm not just saying it from an ego standpoint. I'm saying it because I know I'm just right. Because I have experience to tell me that I'm right. So when I put things on and I'm committing capital, either I'm right or I'm wrong. And if I'm wrong, I'm okay with it because I know exactly where I'm getting at. Okay. Now, with all of that being said, okay, in terms of how your moving averages are now working, to a certain extent, your moving averages are working against you because we're below the 200 and the 200 is flattening out. Can you see that? It's a little hard to see it. I'm going to try and highlight it. You see how it's flattening out a little bit over there at the tip of today? Everybody see that? I highlighted it so I can show it better. Did everybody see it? I want to make sure you guys see it. A flat 200 signifies that the market is comfortable over here. Flat moving averages in general signify we're okay over here. There's no movement. We're okay with it. You're getting a flattening 200 and you're getting your 821 and 50, your momentum moving averages all pointing down. There is the slope. The slope is clear, right? You can all see the slope here, right? You see all these, the red, blue, and green. Sorry, the red, blue, the green, blue, and white. The green, blue, and white. You see that? So the momentum is on the moving average side is clearly to the downside. Okay. That's very important. Why is it important? Because if you're going to be testing longs, you have to know right away that the forces are against you. That doesn't mean you can't take trades. It just means you must be aware that you're fighting the forces. Okay. Now, does that mean that the market can't bounce from here up to here? Of course it can. 100%. Of course you can. And if it makes sense on a trade, should you take it? Of course you should. If that's what you do, 100%. But be aware that you're fighting the forces. Now, here comes the question, because I'm sure you all do this. How many time frames do you guys look at when you make trades? 2, 3, 4, 5, 50. How many do you look at? While you're waiting, I'll be right back. I'm going to come back. I want to see answers.
I did. I was
Freezing.
I was chair freezing.
It's really cold.
You're like literally in telling me you're freezing and starving. You can't like see these exaggerated terms. Okay, got it.
There you go. 1, 5, 15, 1 hour. Hot mic. Okay. Interesting. You're nothing else. 3, 4, 2, 3, maybe 3, 2, 3, 6. Jesus. 3. Okay. Let's ask a question. What would you consider a analytical time frame versus an execution time frame? There we go. That was the question you weren't expecting. Analytical versus execution. Give me time frames. What does that mean? Okay, I'm going to ask a question while you're all typing. For those of you that are trading on a 1 minute and 2 minute chart, how long are you holding your trades for? And I want a serious answer. No, I don't want to hear points. How long do you hold your trades for? On a 1 minute and a 5 minute chart. I'm sorry, a 1 minute chart and a 2 minute chart. Charts, 5 minutes or less, how long are you holding your things for? Max 2 minutes, 1 to 3 minutes. Can I ask you a question? Are you looking at daily charts? Okay, let me ask you a question. Okay, good. I like this. This is good. If you're a 2 minute trader, okay, let's assume a 2 minute trader, okay? If you're a 2 minute trader, that to be honest with you, what are you looking at a daily chart for? No, you're not getting judged. You're not getting judged. It's not a judge. Not at all. I'm trying to give you a logical progression. If you're a 2 minute trader, and you're a 2 minute trader, let's just say you're a 2 minute, you're a 2 minute trader trading the S&P, okay? Whether it be ES, SPY, whatever, okay? And you're saying, oh, the 200-day moving average over here. What does the 200-day moving average on a daily chart have to do with a 2 minute trader? Interesting question, right? If you're a 2 minute trader and you're looking at a daily chart, and you're saying the 200 days over here, what does that have to do with it? What does it have to do with the 2 minute trade? But if you're holding for 2 minutes or less, then it's meaningless to you. If your time frame is so small where you're holding for 2 minutes or 5 minutes, let's just assume it's irrelevant. You know why? Because you could bounce back and forth on that line all freaking day. You're in the chart. You're only in the thing for 2 minutes. So what does that have to do with you? Nothing. No, you won't. You will not. If your holding time is 5 minutes or less, all of this stuff that you've been crammed down you is meaningless. It's literally meaningless to you. If you're holding for the day, it's important. Yes, we'll get to the importance in a second. But if your hold time is 5 minutes or less, or even 15 minutes or less, who cares? This daily chart is literally meaningless to you. Why? Because your hold time is so small that a large macro-based picture, like a daily chart, that means nothing to you. Because you can go back and forth over the 200, you can do it a zillion times. It's not going to help you. You have no edge there. Nothing. In fact, if you're trading in a 2 minute time frame, I will say that you are at a disadvantage because who's your competition? 2 minutes or less, who's your competition? For those of you trading 2 minutes, who is your competition in 2 minutes or less? When you're trading 2 minute charts, who's your competition? Oh, there you go. Let me ask you a question for all of you that are writing this, because you're all getting it. Are you faster than them? I just told you. They can shoot out 10,000 orders in a minute. Are you faster than them? Where's your edge? Where is your edge? So I'm not trying to change what you're doing, but I'm trying to augment it. Open your eyes to understand who you're actually working with. Who are you trading with? Who are you trading against? Who's your competition? what's going on. If your hold time is 2 minutes or less, let me tell you something. It's like basically to put it in the most blunt possible way, as the algos are looking at you, they look at you as shooting fish in a barrel. That's what you are. You're fish in a barrel to them. You think you can compete with them? And it's not the books. I'm not talking about this. It's orders, plain orders. Because when you're in a live market, guess what? Your fills, you might not get them. What are you talking about? When I'm trading in a sim account, I always get filled. Guess what? In real life, it doesn't work like that. In a real market, it's first come, first serve. And if there's not enough contracts or shares available, when you put your order out, guess what? You're not going to get filled. And you're going to sit there. And your order is going to sit there. And you'll be like, huh? Because that's the reality. That's just life. That's the way this works. So you're competing against something that can, and by the way, just so you should know, there are certain algos that are called phantom algos. You ever heard of this before? Phantom algos? They're not predatory, but they're called phantom algos. You know what the phantom algo does for those of you that have never heard of it before? Anyone want to take a guess what it does? The two that just posted? Nope. Nope. Not at all. Nope. They don't hide their orders. They don't put fake orders. Nope. You know what they do? What they do is they reserve a spot online. That's what they do. How about that? It's like having your friend you go to the movies and there's a long line and you have your friend sit there all night long to save your spot. That's what the phantom order does. It's not front running. No, it's not front running. It's not front running. They're just reserving spots. And because it's a machine, they can do a gazillion. It's FIFO, first in, first out. I'm not talking about spoofing. Spoofing is illegal, but it does happen in certain markets. Quasi, like in gold, you see it a lot, but legally, whatever, you see it a lot in gold. In thicker markets like S&Ps, it's just a way to just get you to cut in front of the line. That's all it is. So that's what you're up against, and as a 2-minute trader. And let me ask you a question. If you're a 2-minute trader, it means you have to be basically picture perfect, right? To a certain extent. I'm telling you right now, when you're looking at a daily chart, you're looking at areas. You're not going to be picture perfect. So again, looking at a 2-minute chart, as a 2-minute trader, looking at a daily chart, it's meaningless. So I look at analytical charts a little differently. Okay. I look at analytical charts as, I keep them very simple, because if you make it too complicated, you're one person with one brain and two eyes. How much can you process? So for me, analytical is an hour, a daily, a weekly, a monthly. That's it. Analytical. Execution for me is, because of the way that I trade, is dependent on the opening range or the breakout time that I'm using. So I'm an opening range breakout trader. So it could be a 10-minute, it could be a 15-minute, it could be a 20-minute, it could be a 30-minute. That's my execution. That's the way I operate. Execution should be 15 or 5 minutes. You should not go shorter than that. Going shorter than that, you're fishing you're a fish in the barrel. That's what you are. I hate to say it to you because I don't want to hurt anyone's feelings, but I want to keep it real. I want you to understand who you're actually working against. The machine, and when I say the machine, I'm talking about the computer, does not know you exist. They don't care that you exist. If they got to do things, they're going to do things. So you have to be a little bit more open-minded when it comes to how you're viewing markets. The reason why I bring this up is because if you look at too many time frames, you know what's going to happen? You get so much information overload that you can't make a decision. And anyone who says that they can, afterwards we can have a debate. We'll go crossfire. Pretend we're across the room. I'll put you under the table in 10 minutes. Because it's just the fact of life. How much can you process? And I'm not saying that you're not smart people. You are all smart people. Trust me, I firmly believe that. But how much can you process? You have to make instantaneous decisions with information that's coming at you in split seconds. How much can you process? And by the way, when you start to look at all these time frames, you know what happens? Especially when it comes to moving averages, you get so many mixed signals. You don't know what to do. What do I do? The daily says this, the hourly says that, the 4 hour says this, the 1 minute says this, the 5 minute says that, the weekly says this. What do I do? how do I make a decision? So I like to use, I think, execution for indices and equities, 5 to 15 minutes. That's it. Either a 5 minute or a 15 minute chart. That's about it. Don't go lower than that. Don't go higher than that. You do whatever you want. I'm just telling you the way people are looking at this. If you want to know how real prop traders and real firms are really doing this, that's what they're looking at. The scalping game is an expensive game. You know why it's expensive? Because it's not just commissions. It's on the equity side as well as on the future side. You have the future side a little bit different, but on the equity side, you have ECN fees, you have regulatory fees, you have obviously commissions, then you have taxes and taxes at the end of the year. But I'm saying is, and on the future side, you have clearing fees, you have exchange fees, you have reg fees. Every time you push a button, guess what? Cost you money every time. So if you're going and you're hyper scalping, let's assume, how many of you are hyper scalping? I'm going to show you something. How many of you are doing it? Serious question. Don't be embarrassed. Again, I'm not here to change what you're doing. I'm here to augment it. No one hyper scalps? None of you are doing 30 trades or more a day in futures? Don't be embarrassed. It's okay. No one's judging. It's not a judgment thing. 1 to 5 scalps. Okay. And 20. Okay. Okay. Let's assume 20. Let's assume 20. Is that okay if we do 20? Let's do 10. Let's do 10. Is that okay? We'll do 10. Is that cool for everybody? How much are you making on those 10? How many points are you making on those 10? Would you assume? Take a guess. Now let's assume it's not micros, it's regular full-size contracts. Don't be crickets. Come on. 15 points. Okay. That's an answer. That's 15 ticks. 15 points or 15 points or 15 ticks. It's the difference. Okay, 15 points. Okay, let's go with 15 points on 10 trades. Okay. So a round trip, and let's assume on 1 lots. Is that cool? We'll do 1 lots. A round trip is about $5.36. Let's round it up to $5.50. Okay. 10 trades is basically 20, right? Because it's 10 round turns. So that's 20, right? So 20. Oh, sorry. So 10 times 550 go through you $55. Okay. That's what's costing you. You make 16 points. If you're lucky, 15 points. So 50 times 15 is $750 minus 55. Your net $695. Are you consistently doing this? Consistently. Is this sustainable? When you're a 2-minute trader, let's pretend you're a 2-minute trader for a second. Okay. You're a 2-minute trader. Okay. And you're looking at, I don't know, a 2-minute trader usually is looking for what? 5 points, 3 points, 2 points. What are you looking for as a 2-minute trader? For those of you that are trading on such short, how many points are you looking for? And not NQ, but what S&Ps? 4 points. Okay. 4 points on the ES. Okay, perfect. That makes a little bit more sense. Okay. 3 to 5 points. Let's do 4. That's a good, it's a nice even number. Between the 3 and 5, we'll do 4. Okay. On 1 lots. So 4 points is $200, right? 200. Oops. So now we're going to do 550 times 4. Goes to you $22. Okay. So you make 200 and it's 2. You're at $178. Okay. That's the math. What happens if something goes wrong? And instead of making 4 points on the next trade or on one of the trades, you get caught in some kind of wackiness and you get clobbered for 10. Now what? Now what? How many trades do you have to do to get back to this, to get back to where you are? So when you're doing this kind of trading on a 2-minute, you run the risk of your cost affecting your returns. This is a perfect scenario where you made your 4 points. Okay, congratulations. But real life doesn't work this way. So that's what I'm saying is take a deep breath. It's not a marathon. Okay. Listen, if that's what the game you want to do and you want to play that game and that's what you're good at, it's not my job. I'm not here to tell you not to do it. I'm not here to stop you. If that's what you want to do, go ahead. Knock yourself out. It's all good. That's not what I do. That's not what my guys do. We don't do that. That's not the game we play. Because the game we play is, just so you should understand what we do. Let's quit this. We do the following. We look for this. We look for this all day long. That's what we look for. Juice. See this? Just down all day long. One trade. That's what we're looking for. We'll go to natural gas. One trade all day long. That's what we do. If not for everybody, we're saying that's what we do. We look for that. We don't want to be sitting and running the risk of getting smashed. And that's not have to be trend. We look for juice. That's what we look for. We look for juice. Okay. That's how we operate. Okay. At the same token, this to us is meaningless because it doesn't affect what we're doing. Okay. So that's what I'm saying is when you're doing your analysis and you're looking at moving averages and you're doing these types of things, it has to be relevant for what you're looking to accomplish. If it doesn't fit that, then looking at this all day long is the biggest giant waste of time for you because it's not going to help you. Depending on how you trade, I don't know what you're doing, but it's not going to help you. So when I tell you, I like to give you practical things that you could, it doesn't have to be necessarily trade ideas, but it's thinking a second, taking a step back. What am I doing? Is it working? Is it not working? Why is it working? Why is it not working? Am I looking at too much? Again, I'm not here to change what you do. I'm here to augment you, to get you to think different. Okay. When people are sitting and trading moving averages, they do things a certain way. They're looking for some people look for crosses. Some people look for the moving average to be support and resistance. I don't really view it that way because to me, I'm not a moving average guy to a certain extent in this traditional sense. I look at slope. I don't look at anything else. To me, one line crossing over another line does not mean momentum. I know there are a lot of people who do these moving average crosses where, the shorter one crosses over the longer one, and that means momentum. To me, one line crossing over another line, I don't know why that means momentum. It really doesn't mean anything to me. I look at slope. So when I see this, if I was a long-term holder, okay, this to me does not tell me from a moving average perspective. This tells me bearish. That's what it tells me. That's it. Simple. I'm a big believer in this. KISS. Keep it simple, stupid. I've said this once before. I'm famous for saying this, but I'll also repeat it. If you cannot explain in 2 sentences or less to a kindergarten student what you do, it's too complicated. It's really that simple. It's really that simple. Okay. So when I see this, it tells me right away, damn. When I look at, let's just say, let me find one that's a little bit crazy. Hold on. Here. No, this is also pointing now. Hold on. I want to find a wacky one. Hold on. Here we go. When I see this, it's kind of like crunchy like this. It's not telling me this. I don't know what to do with this. Costco. When we look at Costco, I'm looking at Costco. No, the slope is down. So this is already pointing down. So this is bearish. From a moving average perspective, it's bearish. Okay. If you look at, let's say, so these also bearish. Let's see if I can find one. There we go. It's never perfect, right? What are you looking? It's always what you need when you can't find the example, right? When I see this, like flattening, like this to me is less. MCK. Let's look at MCK. Nope. That's not going to work either. Nope. These are all pointing up. See, these are bullish. These aren't bearish. These are, or if I look at, let's say, no, Valero, I can't find a good one. This is ridiculous. I'm not going to find. This is like not normal. Wow. The XM, let's take a look. It's a little bit crunchy. So let's look over here. Let's see how it's like over here, like messy, like this, flat, doing nothing. It's not a bad idea. This is a TXM, not such a bad example. We're over here, see it's a little bit more, they're like flat. You know what this means? It means do nothing. That's what it means. Market has no direction, has no nothing. So the slope is more important than the actual moving average itself, because moving averages can change because they're constantly moving. Okay. That's what they're called, moving averages. So when people are looking, let's just look at the SPX a second. When people are looking for this, okay, the first test was to try and buy the 200 day. That's what they were trying to do. Because you figured you haven't been at the 200 day in quite some time. It should hold. We should get a bounce, sustainable bounce for at least a couple of days. It didn't hold. We break it. Guess what happens? Get out of Dodge. That's all that you're doing. Okay. So are we cool on moving averages so far? When you're stacked like this and bullish like this, you got your 8, your 21, your 50, all nice like this, your portfolio approach. You're long, you're looking for it. That's what you're looking for. Okay. So you should assume the market should keep going up. When you see them like this, you should assume the market's going to keep going down. And by the way, for those of you that like to pick tops, and for those of you that like to pick bottoms, how's that working out for you? How's that strategy working out for you? And no, I'm not being a jerk. That's what I thought I was going to hear. You know why? Because at the end of the day, you're trying to fit the square peg into a round hole. Trying to pick tops and trying to pick bottoms is a loser's game. You know why? Very simple. How high is high? Who knows? How low is low? Who knows? And the market is there to hurt the most amount of people in the shortest span of time. And it does just, that's what it does. It's there to hurt you. When you're doing this, when you're doing this picking tops, picking bottoms game, it doesn't work. Maybe it works in fake land. In reality, where money is not infinite, it doesn't work and you get hurt. I'm of the belief, and this is going to be somewhat controversial, but I don't care. I am of the belief that from a account blow up perspective, I think you should do it once. That's it. One time. And the one time is only because of the fact that you're working on getting and perfecting your mechanics. If you know what you're doing, you should be in the live market. And if you're working on mechanics and you get blown out, it happens. Fine. You should not be in a situation where you're constantly blowing accounts. It should not be happening. If it is, something is very wrong and you need to adjust. And you need to adjust quickly. Because if you don't adjust quickly, you know what's going to happen? You will be like the 90 to 95%. That is the statistic. You know what's weird about that statistic? You do this action every day of your life. Every day of your life, you buy and sell something, whether it's lunch, breakfast, dinner, groceries, whatever, an app, whatever it is. You do this every single day. How is it possible that a simple act of buying and selling, 90 to 95% fail at? They do this act every single day of their lives, yet when it comes to the market, they fail. How is that possible? That's a question you have to ask yourself. How is this happening? All you're doing here is buying or selling. That's all you're doing. You're not doing anything else. Yet 90 to 95% fail at a simple act that you do every single day of your life. It's something to think about. You have to figure out what makes sense to you versus what doesn't make sense to you. Okay. Again, like I said, it's a little controversial because my belief system in the whole blowing accounts, I don't think you should be doing it. I think it's maybe one, maybe twice, at most 3 times in your career. That's about it. You should not be blowing accounts. Ever. If you're blowing accounts, and I'm talking about, I don't know whether it's real money or these funded accounts, if you're blowing these accounts, something is wrong. And you need to figure out what it is. Maybe you have to take a look in the mirror and say, maybe I don't know what I'm doing. And I'm trying to do something and it's just not working. This is not a business or a game for the meek. Okay? It's just not. This is a game where you got to put your big boy pants on and come to work, because every day you're going to war. And either you're prepared because you're going up against the smartest people on the planet. And either you're ready to go or you're going to get your clock cleaned. I can tell you right now, I don't even have to ask, and I'm not going to, I don't want anyone to tell me, but I can tell you right now, because I'm going to ask a broker friend of mine. I can tell you right now that there were a lot of accounts blown today. A ton. Sorry. Big boy pants or big girl pants. There were a ton of accounts that got blown today. I can tell you this right now. Whether it had been people who were trying to trade the NQ or were trying to buy the S&Ps, there were a ton of accounts that got blown today. More than you can imagine. Ask yourself a simple question. Why? The simple fact is, you know why most people get blown out? Because they don't follow the market. The market's telling them which direction to go. They don't follow it. So they don't know which direction to go, and they don't know where to put their stops. So they get killed. Happens every day. Okay. Any questions on moving averages before we move forward? Before we go, I want to go on to GL's question. I wanted to ask a question. I wanted to address it. I want to get to GL's question. Okay. In terms of moving average strategies, for the most part, I want to say one thing with that. Really, you should be paying attention to slope and paying attention to which moving average is controlling. Meaning, if you see that the market, let's just using this 8 and 21, is riding the 8-day, this moving average is somewhat in control. This is the momentum, it's in control. If it breaks it and you start seeing the 21-day, you know the market's losing steam. That's really the way you need to look at it. And then the 50-day is we're really slowing down, and then something may be wrong. Okay. Okay. Now, it could be. Now, GL, can you type your question again? I can't find it. I'm sorry. Would you mind? I want to address it. I said I would. You had asked the question. I wanted to address it. I told him I would, and I wanted to keep. It gives me a chance to take a drink. So there's 2 questions here, and I want to get to both of them. And they're great, and they're both excellent questions. One is a shorter answer than the other, so I'm going to stick with that one first. Okay. In terms of what time frames, understand one thing. The higher you go up, the more level the playing field gets. So if you go daily, weekly, monthly, at that point, it's a level playing field because everybody has the same information. So there's no difference between you as a small guy and a fund manager at State Street or a BlackRock. You're at the same level playing field from a technical perspective, just by looking at just candles or whatever. Okay. And fundamental data is all available. So it's literally a level playing field. Where there's a difference is that where I don't want to say have an edge over you, but they don't sell. Meaning, when markets are going down like this, and this actually is a great point that they both brought up, and I want to address this. When the markets are going down like this, okay, what do you think the big institutions, if you look at Yahoo Finance, or you look at Morningstar and you pull up a stock, Apple, Microsoft, Amazon, well, let's do that right now. Let me show you something. So let's do Apple. Okay. Let's do Apple. Go to Yahoo Finance. Let's just go to Apple. Okay. Everybody see what I just brought up? Everybody see it? You're going to see if you start going through this, you're going to see something very interesting. It's always the same. Okay. Vanguard, BlackRock, State Street, Fidelity. Okay. T. Rowe Price, our institutional holders, mutual funds, Vanguard. You see, it's always the same thing. Vanguard, what's called Fidelity, the spiders of State Street. Well, you always see this. Okay. Let me ask you a question. A serious question. A real serious question. Okay. Do you think these guys are selling their positions? Who knows where the hell they bought them? God knows what. Do you think they're selling? So how do they protect themselves? Because let me tell you something. You know what? Let's do this. Let's do this. Hold on a second. Because Apple's where everybody's fighting. Let's go in the video. Okay. I'm not going to go to Tesla because I know Lisa wants me to go to Tesla, but I'm not going to. Just kidding. Okay. You look at your institutional holders in the video. Again, Vanguard, BlackRock, Fidelity, State Street. See that? T. Rowe Price. See that? Same thing. It's always the same names, right? Because these are all your top ETF and mutual fund holders. Makes sense, right? So they're not selling, right? So let's just take a quick look at, let's just move this down for a second. Let's take a quick look at the video. The video's getting smoked, right? Flat 200, sloping moving averages. The video's getting smoked. Would you agree or disagree with that? Is this a screaming buy or is this get out of Dodge? You somewhat agree? I mean, what do you disagree about? Oh, okay. So what do they do? Because they're not selling it. Why should they? Because I'm going to tell you something. Okay. If you look at year-to-date, let's just hold on a second. Let me show you something. I want to give you a little bit of an eye opener here. Okay. Watch this. Get this up here a second. Watch this. I'm about to blow your brains out. Okay. NVIDIA. There we go. NVIDIA. Here we go. NVIDIA. Let's see if I can get a year to date. Hold on. NVIDIA year to date. Hold on. There we go. Okay. NVIDIA year to date is down week, month, year. Oh, really? It's not going to work out. Okay, I gotta go get a different browser. Hold on. Doesn't work here so long. Doesn't always work so long in Bing. Watch this. NVIDIA year to date. Everybody see this? Is down 22.65%. Thanks, GL. You see that? Guess what? Down 22%. 1 year. Boom. It's up 24%. Light bulbs. Bing. Do you think these guys are selling? Let's look at 5 year. 5 years. It's up 1,600%. Right here. You see it? Over 5 years. Do you think these guys are worried about that? They're up 1,600% in it over the past 5 years. Oh, 100. I don't disagree with you. But do you think they're worried? Do you think they're worried about a little day where they were down 5%? They could care less. They sleep like babies. No problem. So what do? The institution needs to hedge. So they'll do it by puts. They'll sell S&P futures. That's how they hedge. I ask a question. I always ask this question, and sometimes I get a good answer. Sometimes I don't get such a good answer. So we're going to see if I can get a good answer today. And for those of you that were here the last time, this is for new people. If you were a $1 billion portfolio manager, and you wanted to hedge off $1 billion. See if that's the number. I always forget the numbers. A little more. $1 billion. You need to hedge off $1 billion. Okay. Let's get rid of these. And you're going to use the S&P. How many contracts is it going to take you to hedge off the S&P? To hedge off your $1 billion in stock? How much? How many contracts? How many contracts and how easy is it to do it? I know you do. Keep quiet, you. Don't be a troublemaker. I know. All of you that know this. Okay. That's fair enough. That's a fair thing. I'm going to tell you, for those of you that don't know. 10,000. Okay. Let's figure it out. Current price of the S&P futures is 5870.50. It's $50 a point. Let's just make this. Hold on. Oops. Sorry about that. $50 a point. That means every contract that you own is equal to $297,375. That's what it is. You need to hedge off $1 billion. Let's figure it out. Make this bold, make this in yellow. That's what you need. That's all you need. And you hedged off $1 billion. Let me ask you a different question, because I like your reactions. Now I'm going to pick on you. How easy is it to get off? Let's just route 3,500 contracts in the ES. How easy is it without moving the market too much? How easy is it? I know you don't trade futures, so it's going to be a little bit of a hard question for you. But for those of you that do trade futures, without moving the market, you could get this off without moving the market pretty easy. Pretty easy. No, you could do it pretty quickly. You could do it pretty quickly. For sure, on a day like today, you could get this off in minutes. I would say 10, 15 minutes tops. You have the whole, you could put this order in and get it filled without moving the market. You wouldn't do this during Globex because you'd move the market. You'd be too big for the market. So this would move the market too much. You wouldn't be able to do it. Not that you wouldn't do it. You wouldn't want to do it because you don't want to move the market too much. Because remember, if you're trading ginormous size, then what ends up happening is that you're trading against yourself, and you don't want to do that. You want to be able to what's it called? And by the way, do you think that you could put this on without anyone seeing it? Do a little curveball. Do you think you could do this? No, there's no dark pools in futures. Doesn't exist. There's no dark pools in futures. Everything is on CME. You want to know how they do it? Nope. You want to know how the institution does it? Okay. And by the way, you would never see this on time and sales. You would never see this on a dome. You would never see it. There's two ways they could do it. One, they do it as a swap, and in their history, you never know what happened, ever. And two, like Sully is saying, they break it up into ones and twos. The machine, I told you, can send out thousands of orders. They do this in ones, twos, fives. Maybe they'll do a 10. Easy. Easy. And they don't have to do it all in one shot. They could work this order and they could do it over a handle or two. Easy. It really would depend on the velocity of how the market is moving. On a day like today, you could do this very quickly and very easily because the market has so much velocity to it that it's not gonna matter. What do I mean by swaps? Swap means that I sell you oranges and you give me potatoes. No, it's not supposed to book. They're just swapping stuff. Simple. I want to buy oranges. You want to buy potatoes. I'm selling potatoes. You're buying oranges. I'll do dollar for dollar. We'll switch it around like that. Swap it. In fact, most of the time, a lot of the big orders are done this way, where they just do a swap. You don't even see anything. You could do it in a block, but you'd have to do it very carefully. So I want to go back to GL's question. Oh, yes, they do. Yes. So I'll go a question. For GL, what platform do you use for equities? I don't know if this is available. So Schwab or Webull. Okay. I'm going to ask you, and it's a stupid question, but I'm going to ask you, because I know certain platforms have it, certain platforms don't have it. If you ever look at the SPY at 4:00, do you see like weird spiky action where it's tailing all over the place on, let's say, smaller time frames? Do you know what that is? Down. Do you know what that is? You want to know? Are you interested? Before I answer it, does anyone know what Gio's talking about? Has anyone seen this on the SPY and stuff like this? Where you get like this, it's on the SPY, where you get like this weird spiky action at the end of the day, always 4:00. You can't trade it. Lisa, you're an equity trader. Have you seen it? Nope. An MOC. Good guess though. What it is actually very interesting. If you trade on a dark pool, you don't have to report your trades. The dark pool don't need to report for 30 days. What? Yeah. By law, they don't have to trade for 30. They don't have to report it to the exchange for 30 days. So what ends up happening is a lot of times you're getting these trades that are being reported from 30 days ago. That's what it is. That's why you can't trade them. It's just hitting the tape. At the end of the day, that's all it's doing. They're just reporting it right then and there. Yeah, a lot of forces are going on all day, going on. So it's just reporting that happens, whether it's 7 days or 30 days, it's being reported. They can't report it during the trading day because it would throw things off. Because again, a market maker's job is to keep things fair and orderly. At the end of the day, it's not that the market's not fair and orderly, but now the market's closed so they can report these trades to the tape. That's why you can't trade this, by the way. Don't think that you can. You can't. And if you're in a SPY position and you're holding it, you'll get like weird P&L swings, but it's not real. Oh, let me start again. It's not that it's not real. It's contextually it's real, but it's not tradable real. You understand what I'm saying? Okay. So Gio, you asked a question. The question you asked me was, how do you tell sector rotation, correct? Okay. I'm going to show you. Second. And you should do this, by the way. Since you're asking this question, you should do this. Huh? See this? See the spreadsheet? This is the main sectors of the S&P by weight. So tech is 32%, banks 13, you can see. Healthcare 12, consumer discretionary 10, 9, 8, you see it, right? You're not blind. Okay. I don't want to read it to you like you're a baby. Okay. Tech is the most important sector of the market. Okay. I want to just show you something. Okay. The top 4 names of the S&P make up 23% of the index. The top 4 names are Apple, Microsoft, NVIDIA, Amazon by weight. The top 4 names Of the NDX, Apple, Microsoft, NVIDIA, and Amazon, they make up 31% of the index. So Apple, Microsoft, NVIDIA, Amazon, 4 names are the most important names of the market. Keep that in mind, okay? Just so you should know for yourselves, the top 10 names of the market, of the NDX, are almost 52% of it. Bang. Okay. So what I usually do is when tech is going down, because it's 32%, you can usually see where things are going. Okay. And then you have to assume where the safe havens. So the safe havens are usually utilities and they're, what's it called? Consumer discretionary, consumer staples like Coke, Pepsi, things of that nature. And you can see things moving. So what I usually do is I have a lot of cash indexes so I can see what's red, what's green, where's money flowing. And I just judge it that way. For the most part, when the treasury yield is going up, the TYX is going up. Usually dividend stocks are going to start doing better. Utilities are going to do better. Tech is going to get cleaned. Okay. So right now they're rotating out of tech, obviously. Okay. So it's just really how you judge it that way. Okay. But you have to know what the sector weightings are. Once you understand the sector weightings, it becomes a lot easier. Okay. Any questions before we wrap up this part of the presentation so we can move along because it's getting late. I don't want to bore you anymore. Gio, did I get your question right? Did I get your question for you? Of course. Go ahead. Yes. They build positions over time. Yes. Yeah, they do, but they build positions over time. The way an IPO works, by the way, is the funds already have their allocation before the IPO starts, just in general. And then they just start building positions over time. And then they just sit in them and they don't get out. The only way they'll get out, that's not true. That's not true. If something fundamentally changes. So for example, let's say you're a dividend company and you run a fund that's a dividend paying fund and it invests in dividends and dividend paying stocks. If let's say you're Intel, which cut its dividend, they have to get out by law, because of their mandate, they must get out. That's the only way they get out. There's fundamental shifts. Okay. Like real fundamental shifts. So a dividend payer or a high yield dividend payer, they'll have to adjust to things like that. Or if there's significant change in a business. So if I don't want to, this is being recorded, I want to put a name out there, but if you have a name, let's say that gets caught up in an accounting scandal and it's really bad, and there's a possibility that company could go out of business, they'll get out. They have no choice because they can't write it all the way down if the company's going out of business. By the way, pension funds are long only. 80% of the market is long only. That doesn't mean that they're constantly buying. It's long only. Keep that in mind. Pension funds, mutual funds, they're long only. So just keep that in mind. Okay. Any other questions before we wrap up this recording? So I'm going to stop the share. I'm going to stop the recording. The recording will be available whenever Steve posts it.